Hello, this is Dr. Seitz, and today we are going to look at a problem regarding merchandising businesses and how their accounting is a little bit different than what we have been doing, which has been service businesses. So we're going to look at this particular problem. It's a demonstration problem for perpetual inventory transactions. So Katie's Dress Supply, a garment wholesaler, experienced the following events in year one. In its first year of operations, KDS uses the perpetual inventory system. So there's a difference between a perpetual and a periodic inventory system. So I want to make sure that you go back and review the differences, but basically most businesses run on a perpetual inventory system. So after every purchase, the inventory system will update the inventory balance on the balance sheet and the cost of goods sold expense on the income statement. So KDS was started when it issued common stock for $60,000 cash. And so what I am going to do is I have this for you available, but additionally, I am not going to be switching back and forth between screens because I don't want to make you sick. So hold on just a second while I pull up this problem so I can have it sitting beside me so I won't be switching back and forth. But this information is available to you on Blackboard. All right. All right, so they issued common stock for $60,000 cash, and as you can see, that one's already done for you. So there would be an increase in cash. There would also be an increase in common stock. And this one doesn't ask for it, but that would be an that would be a financing activity on the cash flow statement. The second one says they purchased inventory on account with a list price of $54,000. So that was their cost. Payment terms were 210 net 30. And so in your reading, you would have found that companies use payment terms in order to speed up cash flow, that way that they can pay their bills off sooner. And the textbook goes through the calculation of not paying off within this time period. So this is a 2% discount on the balance if paid within 10 days. If you do not pay the full balance within 10 days, less a 2% discount, then you have to pay 100% of the balance in 30 days. And so I think it's around 35% annual interest in the event that you do not take advantage of that particular payment terms. So it's really beneficial on both parts in the event that you have the cash available. It actually, sometimes, if you're a good cash manager for a business, it may make sense to have an open line of credit with a bank to where it's a little bit like a personal credit card, but it's different in that there's not an actual card. You would have to call the bank each time and ask for a draw on your line of credit. But basically, those interest rates are considerably cheaper than the annual interest rate if you do the calculation for the 210 net 30 payment terms. So like I said, it's around 35%. You can get an interest much cheaper than 35% at a bank. So it just depends on how good of a money manager you are. Because you don't want to get an open line of credit and then extend your credit to spend the money on the open line of credit whenever you don't even need the things that you're buying. So just like a personal credit card, we don't want to do that either. So we're going to have, the second one is an inventory purchase. And so we're going to see that inventory increases. $54,000, but instead of cash, you're going to see an increase over here on accounts payable. This would not hit the cash flow statement because we have not paid cash yet. The freight terms for the merchandise delivered were FOB shipping point. KDS paid the freight of $1,000 in cash. So this is a little bit different. Sometimes the freight is included in the cost of the merchandise. This one was actually paid separately with cash. So FOB shipping point means that if it's FOB shipping or FOB destination, whatever point it is, that's who actually takes ownership of the merchandise. So FOB shipping point was the owner takes, that the buyer would take ownership of the inventory at that particular shipping point. So they own it during transit, and they're also paying shipping, which is pretty common. usually whoever owns it during shipping pays the shipping fee. So this is transportation in. We're going to see a 1,000 decrease in cash, and then we're going to see an expense where this is actually charged not to like a shipping expense, but this expense is actually charged to inventory. So this increases the cost of inventory. Four, an inspection revealed that merchandise with a list price of $4,000 purchased in event number 2 was defective. So they returned it and wanted to receive credit. So this is a purchase return. Purchase return. We're going to decrease our inventory because we're going to actually send that inventory back, and then I'm going to decrease my accounts payable because obviously I'm going to pay less for my accounts payable. 5, KDS paid within the discount period for the inventory purchased in event number 2. So that's good that they paid within that discount purchase. So one thing that we want to record is the actual discount. So the discount would be 2%, not on the $54,000 because we returned $4,000. So 2% on $50,000 would be a purchase discount of $1,000. So purchase discount of $1,000. I'm going to decrease my inventory by $1,000. I'm also going to decrease my accounts payable by $1,000. I'm going to pay that accounts payable. I'm going to pay $49,000 because I received that discount of $1,000. So you're going to see cash outflow of $49,000, and then you're going to see a decrease in accounts payable of $49,000. That would also hit the cash flow statement as an operating activity. 6, KDS sold the inventory to various retail stores on account. KDS offered customer payments of $115 net 30. Oh, sorry, my dogs. $115 net 30. So a 1% discount if paid within 15 days. Otherwise, the full amount has to be paid within 30 days. The list price for the sales was $68,000. The cost of the inventory sold was $42,140. Hold on just a second. All right. So we paid the accounts payable. Now we sold the inventory to various retailers. So on account. So we're going to have some accounts receivables. Make sure I can see where that's at. Accounts receivable. So you're going to see sale of inventory, accounts receivable. Accounts receivable is going to increase by $68,000 because that's how much we sold it for. That was the list price. That's how much we're going to actually receive. And so we're going to see an increase in retained earnings because that would be sales revenue. Okay. So that would also hit the income statement at that particular time because that's when we actually sold it. But at the same time that we record inventory, the sale of the inventory, we have to record the cost of that inventory. And that's what cost of goods sold is. Cost of goods sold is the actual expense of the inventory that you sold. So this is one of the major differences between the sales of services and the sales of inventory merchandise. So we don't have that whenever there's a service. So there wouldn't be a cost of the inventory sold whenever there's a service because, well, there's no inventory. So we have to record that sale of inventory and the cost of that inventory. And it told us, the problem told us that the cost of the inventory was $42,100. So cost of goods sold is going to decrease my inventory by $42,140. Okay, and then that's also going to hit my income statement. So you're going to see a decrease in inventory of decrease of net income or retained earnings, because remember, any expenses decreases retained earnings, which decreases net income. So you can actually calculate the gross profit on this particular sale by finding the differences between the revenue and the cost of goods sold for that particular item. The next problem is that some of the customers return the goods that were sold in event number 6. They were sold for a list price of $4,000, but they had a cost of $29.40. So just like whenever we make a sale, if we make any returns, we have to keep the difference between what we actually sold the items for versus what we paid for the items. Okay? So the difference between there, that's that gross margin or gross profit. We're going to do a sales return. We want to keep this separate too. We don't want to just muddy it up and show it as a decrease in sales. So we're going to actually keep it separate and call it a sales return. So you're going to see it actually be very, it looks kind of muddy right here, but whenever we see that, there we go. Whenever we see that on the income statement, you're going to see that that's actually called a sales return. And so gross sales less sales returns and allowances and sales discounts would actually get us to net sales. And most companies report net sales. They don't want people to see how much they have in sales returns and allowances or sales discounts. All right, so now I need to adjust the cost of goods sold for the amount that was returned. So you're going to see me increase the inventory by the cost of those goods sold because they came back to us. I'm going to increase the inventory, and then we're going to have an expense reduction, basically, of $29,400. KDS paid in cash freight cost of $1,200 for goods delivered to customers, FOB destination point. So here's another example of shipping costs or transportation costs, but this is transportation out. KDS now is paying for that freight cost, FOB destination, so they own the inventory during transportation. Therefore, they're paying for shipping. Now, this is really important whenever companies come in and want to count inventory. They need to know what inventory is in transportation and who owns that inventory, because that would need to be included on the balance sheet. So that's why it's really important to identify who owns it during transportation and who pays the shipping costs, because that will be who has the inventory on their balance sheet at that particular snapshot in time. So we're going to call this transportation out. We paid that in cash, so this would hit the cash flow statement. And then this would be just an expense. This doesn't do anything to our inventory. This is just an expense. This is an additional cost to our inventory, like that transportation in. Notice here that transportation in was an additional expense, which basically increased the cost of our inventory. Well, it doesn't do that whenever we pay it because we're making a sale. When we're making a sale, that cost is just an expense of doing business. And so you're going to see that as just a shipping expense that would hit the income statement, not an increase in the value of the inventory that would hit basically cost of goods sold later. All right, 9, KDS collected cash from customers who paid their balances within the discount. These receivables were reported at a gross price of $50,000. Okay, so they had a sales discount at 1% if they paid within the 15 days. So I'm going to record a sales discount. 1% of $50,000 would show a decrease in accounts receivable of $500. We're also going to show a decrease in basically what's going to hit our net income of $500. This would be a sales discount. And again, that would be separately reported on the income statement, the multi-step income statement, to help you calculate gross sales less sales discounts, sales returns. That would help us calculate net sales. So here's where we collected accounts receivable. So we collected. So the difference then between the $50,000 and the $500 discount is $49,500. And then you're going to see a decrease in accounts receivable of $49,500. And this here would hit the cash flow statement for operating activities because we actually received cash flow. KDS paid $9,600 in cash for other operating expenses. So this is pretty simple. This is what we've been doing the last 3 chapters. Okay. So then if you do the math down, start with the beginning balance right here. You see your beginning balances, and then you add and subtract based on all the transaction. you should come up with your ending balances. So I'm going to end this video and start a new one to prepare the income statement or to prepare the financial statements.